have you explain to people what a startup actually looks like, what the goals are, what you do when you achieve said goals, and kind of the downwind effect of that.
Yeah. So let's specifically talk about venture-backed startups.
Yes.
Because there are other startup companies that people bootstrap and they become lifestyle businesses. Even if it's a software business, it could just be kind of a lifestyle business that pays for your, your personal salary and your lifestyle and all that type of stuff. But primarily what Silicon Valley is known for is for venture capital-based businesses. Why should a potential company or specifically software company raise venture capital? If they want to own a market, dominate a market, scale really quickly, grow really fast, right? Because you can grow faster with upfront capital to invest into your growth. And so the way that it's constructed in the Silicon Valley is, especially in these times where people have seen the playbook multiple times work, you can have a vision oriented around a problem or a pain point that you want to solve. You can recruit a couple of co-founders and you can create a deck and a prototype. On that, you can have enough in just that, assuming that there is credibility, pedigree, experience with the founders, assuming that the problem and the pain point are deep problems and pain points, assuming that people have conviction that you're the team to be able to solve that problem, and assuming that people agree that enough people have that problem for it to represent a big market. If those things are true, what you can probably do in the Silicon Valley specifically is email that out to high net worth individuals, what we call angel investors that maybe have made money in tech before, understand the software business, and do what's called a pre-seed round or a friends and family round. You can typically raise, anywhere from $250,000 to $500,000 to pay for the co-founder salaries, to pay for the initial software services that you need to resource to get the product up and running, et cetera, et cetera. If you get to certain milestones, so for example, you get to, maybe 6 figures in revenue, let's say, you have some testimonials, case studies, you have a proof of concept that there's some traction with this business. It's not just an idea on a slide anymore, but there's real traction. Then you can go out and pitch professional investors called venture capitalists in what's called a formal seed round. That seed round might look like anywhere from $2 million to $5 million.
Okay.
This is where you can really build out a more professional team. You can hire more engineers. You can scale the product further. You can buy more infrastructure so that there's scalability, security, all that type of stuff to get more serious customers and to scale the current customers that you have. Invest into marketing maybe a little bit and things like that. You get to the next milestone. That might look like $1 million in annual recurring revenue. Once you hit that marker, you would be ready for what they call a Series A. It's your next round of financing. This financing round is maybe anywhere from $10 to $20 million.
Wow,
right?
So it's a big jump.
Yeah, and then so forth and so on. The next round of funding, maybe you need to get to like $5 to $10 million plus in annual recurring revenue, and then you would be worthy of a Series B, which could be anywhere from 20 million to 50 million. I have a friend that just raised a Series B for 63 million.
Wow.
Right? A fintech company. And so the progression goes on.
Sure.
Okay. So what's happening in the background? Well, each set of investors are investing at a certain valuation. They're buying a portion of your company at a certain price at any given time, right? Sometimes they do it based on what they call the market price. It's what people are willing to pay for based on your idea, your pedigree, their believability that you're going to make this happen. And sometimes they base the valuation on real economics. So a multiple of your revenue. So for example, for software as a service businesses, what they might value you at is 10 to 20x your ARR, your annual recurring revenue, if you're a high growth software business, and that's the price they're going to pay.
Okay.
So for example, let's say that the pre-seed round, they purchased a part of your company by investing in your company at a, let's say, $2 million valuation. Seed round, purchased it at a $10 million valuation. and then Series B round purchased it at a $50 million dollar valuation. That pre-seed round that purchased it at a $2 million valuation, when you raise a Series A at 50 million, just got a 25x their money on paper.
Got it.
Okay.
Yeah.
So you keep progressing, you're serving customers, you have more buying into your product, you're making more money, you know, all that type of stuff. What are the quote unquote exit opportunities for a startup? Because ultimately investors are not investing, this is not charity.
Right.
Out of the goodness of their heart. They're investing to get a return on the investment. So how do people get a return on their investment? Well, there's two main paths. You either sell, right? You can either sell to what they call private equity, which is banks.
Okay.
To get liquidity, or you can sell to a bigger company. So you can sell to like a Google or a Meta or a Salesforce or a Stripe or something like that. So that's one way where you can pay out all of your employees, pay out all of your investors when there is what they call a liquidity event. Okay. The other way to extract money from the company is to do a public fundraise. So that's the NASDAQ, that's the New York Stock Exchange, that's the ring the bell moment. Okay. That's the whole, we're going to issue shares to the public, and the public is going to buy shares in the company, which creates a liquid stock. Now employees or investors that are invested or employees of the company that have stock or stock options can now sell their shares like it's regular money.